This is the study session on alternative investments and the sole reading, Introduction to Alternative Investments. This is the final study session. This is the final reading. And let's make sure that we give it its due because it is important. First LOS asks us to compare alternative with traditional investments. And so we've been talking about traditional investments for the last, 56 or 57 readings. Of course, these are things like shares of stock, these are things like bonds, and these are things like money market securities or cash. These are well known and well utilized by investors, not only today, but historically. So they're known as traditional investments because they've been used for quite a long time. Alternative investments, on the other hand, pretty much is characterized by any kind of a security that doesn't fall inside the equity and the fixed income and the short-term universe. And these include things not only like real estate or derivative securities, which we just had a great discussion in the previous two readings, but it includes, in addition to derivatives, it includes things like a stamp collection or investing in an oil well, or movie memorabilia. So anything that falls outside that traditional debt and equity universe is probably considered to be an alternative. How about some other characteristics? Now, we know when we think about the equity markets, we think of the floor of the New York Stock Exchange with lots of buyers and lots of sellers. And so we think of lots of liquidity. I mean, if you want to buy, somebody's willing to sell. If you want to sell, somebody's willing to buy. And the same is probably true, maybe a little bit less so over in the fixed income market, but there's typically lots of liquidity with traditional investments. But with alternatives, there might not be. I mean, how difficult might it be for you to sell the white suit that John Travolta wore in this movie Saturday Night Fever? There's probably a market for it, but you're not going to sell it as quickly as you would a share of stock. Couple of other things that are important. There's probably more narrow manager specialization in the alternative investments universe. And there's this issue of diversification. I mean, when you hear people talk about traditional and alternative investments, they always talk about, oh, we're going to get some benefits of diversification. And this is only true because there is low correlation. I mean, think about it. What do you suspect is the correlation between a handful of diamonds and a share of stock that's traded on the floor of the New York Stock Exchange? You know, it's probably close to zero. I mean, it might be a little positive or a little negative. In addition, with traditional investments, you can probably go back and find 20, 30, maybe 70 years worth of price data. So it's easy to evaluate the historical risk and return in traditional investments, but such is not the case with many alternative investments. You know, how about a stamp collection? Can you get daily prices on a rare stamp collection? Clearly not. Can you weekly? Probably not. Monthly? I wouldn't even think that, but you know, maybe every 6 months or maybe every year. Alternative investments are also characterized by less transparency and less regulation. Here's a great example. Did you guys read just the other day, Jerry Seinfeld sold one of his Porsches for well over $1 million, and the people who bought it claim that it's a forgery. I know that the actor Steve Martin bought a forged painting. And so, of course, when you buy a share of stock on the floor of the New York Stock Exchange, that's pretty transparent. You know what you're getting. But if you buy a vintage car or a painting, you might not. So there's less regulation, less transparency. And then, of course, tax considerations and the legal considerations are unique to that specific type of an alternative investment. How about some categories? Hedge funds, private equity funds, real estate, and commodities. So hedge funds, what do we know? Hedge funds are very similar to mutual funds. The mutual fund manager says something like, hey, send me your money. I'm going to invest in stocks and bonds or maybe some combination of the two. But a hedge fund manager says, hey, send me your money. I'm going to do whatever I want with it. I'm going to seek out leverage. I'm going to look for derivative securities. I'm going to find both traditional and alternative investments so that I can provide a superior return than just the regular mutual fund universe. Private equity funds, on the other hand, are usually pools of funds that are combined from, let's say high net worth investors and lots of loans. And what they do is they go and they invest in companies directly. And so they kind of take over a company, and then maybe they'll manage it for a while, and then they'll have an exit strategy after 5 or 7 years. Now, real estate investment is really fascinating because it can mean almost anything. I have a friend who I grew up with who bought a post office, and he bought a mall, and he bought apartment buildings. And, he's probably 60 years old now, and he's had that income for probably 30 years. Commodities, on the other hand, these are really fascinating securities because their prices fluctuate all the time. And we have the spot market for things like oil and gold and orange juice. And then we have the futures market for these kinds of things, and also the options market as well. And so you don't really have to go out and buy an oil well. You can just go to one of the organized exchanges and take the long or short position in an oil futures contract. And so investing in commodity is much easier these days than it used to be. And then, of course, there are other types of alternative investments that include things like investing in roads and bridges and patents and copyrights. How about this one? Describe potential benefits of the alternative investments in the context of portfolio management. All right, so what are we doing here? We've got a client. This client has a risk and return objective, and we're trying to do something by investing in these alternative investments. And so here are 3 really good answers, but these are answers that we give with almost any other kind of financial security. We would love to have diversification. And we know that there are diversification benefits because there are low correlations. I read something in the Wall Street Journal recently, the correlation between investments in old wine. I mean, I'm not a wine guy, but if you invest in wine that's, 20 or 50 or 100 years old, that's negatively correlated with what goes on the floor of the New York Stock Exchange. So there's no doubt that there are low correlations. But they also might provide higher yields. So there's the income possibility, and then there's the growth possibility. All right, let's go through each one of these. Describe hedge funds. We'll start with that. Hedge funds. They're private, actively managed investment vehicles that capitalize on various investments. So in the hedge fund universe, the hedge fund manager typically says, I'm going to take your money and I'm going to invest it wherever I want. Now, of course, those will be outlined in the prospectus. It's not like the hedge fund manager can take your money and go to Las Vegas and bet it on the Super Bowl. But they do employ aggressive strategies, and they use derivatives, which means there's high leverage. They try to take advantage of some arbitrage opportunities. We talked at length about arbitrage back in the derivative securities discussion. And other investment strategies that are not available to traditional fund managers. Remember, those mutual fund managers, they're pretty limited. They say something like, I'm going to take your money and I'm going to invest in stocks or in bonds or some combination of the two. Now, traditional fund managers tend to focus on the long term, but hedge fund managers can be myopic. They can focus on short-term earnings. Now, when investors choose a particular hedge fund, they're probably restricted in some way in terms of the redemption and the redemption structure. A traditional mutual fund will probably allow you to get your money back almost at any time. But with a hedge fund, there are all sorts of fees and policies that keeps your money inside of that particular hedge fund. Maybe it's a lockup period, maybe it's a notice period, maybe there are some redemption fees. These hedge funds are generally not heavily regulated, and they are exempt from laws that the traditional mutual fund managers are not. Another interesting thing about hedge funds is that they have a performance-based fee. And so what happens is that the hedge fund manager will say, all right, if I'm collecting $100 million today and I turn it into $120 million by next week, hey, I'm going to take a portion of that $20 million capital gain, let's say. I'm going to take advantage of that, and I'm going to use that as part of my compensation. And look at the growth. I mean, hedge funds have gone from being, in the several $100 billion 20 years ago to well over $1 trillion today. Private equity funds are really, really interesting kind of an animal. What they do is they directly invest in company. And so what they do is they go out and they scan the environment for privately held companies. And a lot of times these are family-owned business or at least family-founded businesses. And they go in and take over that business. A lot of times they do it with debt. So these are leveraged buyouts. There's no doubt that this is a focus. The focus is long term because they're going to invest in this company. And a lot of times the private equity fund manager takes a managerial role in running of the business. And so, if I'm an expert on driveway paving and blacktopping, well, then I can take over a company that I think is poorly run, and then I'm going to go and say, hey, I think you guys should do this and this and this. Of course, that makes perfect sense. How about real estate? Typically owned by the title deeds, of course, just like your home. Falls into several categories. There is residential, which of course is regular home ownership. There is commercial, which would be like a mall. There are industrial, which would be like a manufacturing park. Agricultural, of course, is farmland, and then the forests are timberland. And so the interesting part about this, just like I told you about my friend, is there's no fixed maturity. You can own this property for a really long time. Some people believe that the real estate market is not quite efficient. And the reason that this is probably true is that there tends to be a high degree of information asymmetry. And so if you have some private information, then you have the ability to make these high profits. And there are great television shows about, flipping a house or buying a structure and then stripping it from its lumber and then selling the lumber for way more than you paid for the house. Of course, this is really popular with old barns and old structures that have wood that might be 100 or 150 years old. And there are people that would pay a lot of money to use that wood as part of the new construction in their home. And liquidity is probably low. Now, of course, we have access to this mortgage-backed security market. I mean, there's pretty good liquidity there because there are lots of buyers and sellers. But other than that, real estate liquidity is generally low. And you guys know this when you've sold your home. It's not like you put your house up for sale and there are 27 people standing by your mailbox. How about commodities? Most people don't go out and buy farmland or a natural gas well, but they get exposure through derivatives. And so you can easily buy or sell futures contracts and option contracts, even swap contracts. And so you can gain access to the commodity market. And lots of people like this market because it's a hedge against inflation, although it doesn't work perfectly, but it's a hedge against some types of inflation, like energy costs and food costs. And then the last part is this infrastructure in which there are companies that participate in the construction of bridges and tunnels and communication equipment and factories and all sorts of stuff like that. How about if we calculate, oh my gosh, there's a mathematical one, and interpret management and incentive fees. All right, so let's look at the difference between the management and the incentive fee difference. The management fee is usually based on total assets. And so if I'm some kind of a hedge fund manager and I have $100 million in total assets, I'm going to just charge a management fee like some number, maybe 2% or 1% or 3%. And so I'm being compensated for my ability to raise lots of capital and my ability to do something with it that's going to satisfy all of the owners. And then I have an incentive fee that if I, in fact, increase the value of the portfolio, increase the value of the fund, then I'm going to be able to capture some of that as compensation for my high skill set. Now, the incentive fee can be calculated either separately or net of the management fee. And so a lot of hedge funds have what's known as a 2 and 20 fee structure, 2% management fee and a 20% incentive fee. And the incentive fee is probably only paid after the fund reaches its high water mark. And I'll show you that in an example in a few minutes. Let's suppose we've got a hedge fund that has $100 million in assets at the start of period 1. So that's time period 0. The fund grows to $120 million at the end of 1 year. Then it falls to $90 million at the end of the second year, and then rises to $140 million at the end of the third year. And so this is a fascinating example. So you have this fund, it goes up sometimes, it goes down sometimes, and it goes up sometimes. All right, so let's calculate the return to the investors, and let's do that if the incentive fees are not calculated based net of the management fee, and we have one of those 2 and 20 fee structures. All right, so at the end of the period 1, what do we know? It went from 100 to 120, so there's a $20 million growth. Management fee then is going to be 2% times the 120 million. That gives us $2.4 million in management fee. And then the incentive fee is going to be the 20%, right? The 2 and 20, the 20% of the difference between the initial value and the value at the end of the period. So that's $20 million times that 20%. That gets us 4. So if we sum the 4 and the 2.4, we get 6.4 million, and that gives us a 13.6 return to investors. Now, if we computed the return in which the incentive fees are calculated based net of the management fee, then we would just take that 2.4 out of the 20 million. So make sure you read the question stem carefully to see if the incentive fees are or are not calculated based net of the management fee. Let's go ahead and look at period 2. So what happens? We lose $30 million in period 2. Management fee is going to be 2% of that 90 million, the value at the end. So there's 1.8. Now the high water mark was 120 million. So there's going to be no incentive fee paid when we go from the 120 down to the 90. So the total fees are just the 1.8 million. But we know that something good happens in period 3. Let's go ahead and figure that one out. So the growth from 90 to 140 is 50 million. So we're going to take 2% of that 140 million, gives us 2.8 million in the management fee. And then the growth over the high water mark is now 20 million, right? That high water mark was 120 a couple of years ago. We've now gotten back over that. So we're going to take 20% of the difference between 140 and 120. That gives us another 4 million. So if we sum the 4 and the 2.8, we get 6.8 million in total fees, and that gives us a whopping 48% return to investors. All right, so what did we do here? We started with 13.6, then we lost a little bit more than a third, then we got back a little more than half. Now we can sum those. Total for the 3 periods is 40 million. The management and incentive fees sum to 15 million. And so you can calculate a total return to investors over that 3-year period of 25%. How about if we describe issues in valuing and calculating returns on some of these alternative investments? And so there are a couple of important issues. Concerning the redemptions of hedge funds, following periods of poor performance, investors are probably going to exit the fund or redeem, maybe all of their shares or a fraction of their shares. And so what this means is that the fund will be forced to sell some of its assets, possibly when they are lower in value, and that's going to lead to not only selling at the low value, but some extra transaction costs, which are going to magnify the losses. And then there's the issue of the market prices for valuation. We know from our days in describing what goes on the floor of the New York Stock Exchange and over in the NASDAQ exchange, there's a bid price and there's an ask price. And then there are quotes and average quotes. And so, what do you use for this? What do you use in order to determine the actual return? How about some issues in private equity funds? Remember what we're doing is we're going to invest as a private equity fund manager. We're going to invest in a pool of individual privately held companies. And so really the only way to value those is through some kind of a discounted cash flow model. So we're going to have to estimate those future operating cash flows or future free cash flows. And remember, we can do free cash flow to equity or free cash flow to the firm, depending on kind of the circumstances. And so the assumptions that we make in that discounted cash flow method is going to help us determine the value of the firm. And so that's going to help us determine the value of the private equity fund. And then, of course, we need to concern ourselves with the exit strategy and the cash flows involved in that exit strategy. That's going to influence the return calculation as well. Now, with real estate, there are a couple of issues here. We can value it based on just like we did in private equity, the income generated. And remember, there's a whole slew of calculations to compute the cash flows under a particular piece of real estate. Or we can just go and look at all of our neighbors and say, okay, we're a miniature golf course here. What are those 4 miniature golf courses around us? What do they look like? And what kind of assets do they have? And what is their value? So that's called the method of the comparables. And the other one is based on income generating. Now, when you do both of these, you got to make some kind of an assessment on things like vacancy rates and cap rates and rental rates and the legality of specific factors that are relevant to particular properties. I mean, maybe there are rules associated with having a miniature golf course in Ocean City, Maryland, and there are different rules in owning a golf course right across the Delaware border in Fenwick, Delaware. How about issues with commodities? Remember that on the floor of these organized exchanges, these contracts are standardized, and so the value depends on the standardization of the exchange, which will determine the quality, it'll determine quantity, it'll determine the grade and the location of delivery and the time of the delivery and other things. And so to value those commodities, we also need to worry about storage costs and the convenience yield. And then infrastructure returns are interesting because you got to worry about regulatory risk and construction risk and the reliability of cash flows. I mean, when you go to the beach in Maryland, you almost have to cross over the Chesapeake Bay Bridge. And it costs, I think we're up to $6. You only pay it one way. And so the value of an infrastructure investment depends really on how many people are going to go to the beach during the season. Now, one of the things about this is that sometimes, and maybe even oftentimes, there's heavy regulation here. So if there's lots of regulation, then returns probably are more easily computed. Now, let's go ahead and take a lesson from Jerry Seinfeld and Steve Martin. For all of the investments and alternatives, due diligence is the key. So what do we need to make sure that we do as good financial analysts? We need to make sure that we go and investigate the quality of the underlying asset, whether it's a post office building or a mall or a vintage car. Remember, when we were putting together the policy statement, we also wanted to take a look at a macroeconomic analysis and an industry analysis, and we can apply those same principles to study the market forces before investing. We need to make sure we consider all those risks, such as a lack of liquidity. Alternative investments should always be viewed as a component of a well-diversified portfolio. And that takes us through